Hey everyone, good afternoon. Good to see everyone. Hope you're having a wonderful day. In Oliver Kollofski, Director of Wealth Services, here with Sweet Financial Partner, also Wealth Advisor, here to share with you this month's edition of Sweet Financial Live. We'll share some updates on the market and a few planning things we want to share with you as well. So a few items, housekeeping type items. I've got I guess the chat box and Q&A box on my other screen. So if you see me looking to the side, that's what's over there. So if you have any questions or anything as we move along, feel free to type those in the chat box. You will remain anonymous. So let's start with volatility. Let's chat a little bit about volatility, a common common thing that comes up. How volatile are the markets? Well, let's examine that, and we'll examine kind of a theme throughout today's discussion. So, number one, if you ask yourself, has 2023 felt volatile? And some of you may say yes, some may say no, some may say I'm not sure. All three of which are totally acceptable and logical answers. So let's look at some data. So this chart, I'll explain what all the numbers and charts mean here. So let's go through this. So this is going to be back to 2009. So I've got various charts here today. They're going to have various time frames of data, and I'll try to always outline the data time frame over which we are looking. So this goes back to 2009 up through 2023. A lot of the investment firms or data firms where we get data, those data firms update their data quarterly, some monthly, some quarterly. So this chart here is going to be through the end of quarter, the most recent quarter, which would be March 31st. So through first quarter. So 2009 through first quarter of March, and the blue bars it's going to be the number of days in the year where the S&P 500, so think the large US companies, the number of days with a 1% move. It can be either up or down, 1% up or 1% down. That's the number of days. So let's first start with the orange horizontal line. It's at 66. So 66 days. It's the average number of days with a 1% move in the stock market, the S&P 500. So let's first start with 2022. You can see since 2009, that was the most volatile year. There were 122 days. Unfortunately, a lot of that volatility was to the downside. And let's look 2017. If you think back several years, 2017 only had 8 days. It was the least volatile year by far. So let's look at 2023 now, this year. This is through March 31st. So 29 days. So we'd have to annualize that. And if we did that, it's been, again, a volatile year thus far. But the good news is this year, anyway, most of the volatility, or a lot of the volatility, has been to the upside. So if it's felt a little volatile the last, call it 18 months, it has been. And we'll have more charts to share with you on that topic. And I'm speaking relative to since 2009. Again, any questions, you could type those into the chat box or the Q&A, question and answer box. And again, you'll remain anonymous, if you will. I'll read that question and answer it as best I can. The next slide here, this is an interesting one. A few more data points here. So I'm going to grab my pen and to be able to draw on the screen. I think I've got it here. So we're going to look at two stock market indexes, both US, but the first one over here in the blue is going to be the S&P 500. And this one, we're going back way further. We're going back 1942, so like 80 years of data. So a lot more data, a lot larger sample size here. And same with the Dow Jones. So the Dow Jones, as the name implies, think of that as not necessarily the tech companies, but the S&P 500 sometimes gets dominated by the technology companies. More on that later. There's a really interesting slide. Something very unique has happened this year. So how often do we really have declines in the market or volatility? So if we look at how often is there a 5% or more decline, that happens historically, again, going back about 80 years, like 3 times a year, and it typically lasts 40 days. And the last occurrence, it was actually this year. Yep, it was March. Even though the market is up this year, right, we did see a 5% decline in March. The next item, you can see the last occurrence for all the others, October 22. Yep, that would have been like the low point. That would have been when it happened. So we're talking either a 10 or 15 or a 20% decline. So 10% declines happen every, let's call it year and a half. I do a little bit of rounding. A 15% decline happens once every 3 years. And a 20% or more decline happens every 5.5 years, let's call it. Yeah. Yes, the Dow Jones in this case, very similar. About 3 times a year, 17 months compared to 16 months, 2.66 years and 5.75. Normally the Dow and the S&P track one another fairly closely. I'll show a chart in a minute where recently they've had some divergence. So again, 10% decline, 15% decline, 20% decline. I mean, those happen. Those are normal. It's certainly not a straight up movement in the stock market. It never has been, and it probably never will be. So that's some perspective in terms of historical downturns. So this would be again the S&P 500, but a different time frame. We'll go back to 1980 here. 1980. And the gray bar, up or down bar, would be the return for the calendar year. And the red dot would be the intra-year decline. So even though the market could be positive for the year, maybe it from June until October or something, it went down, but then it finished the year positive. So if we look going back to 1980, the average intra-year decline is about 14.3%. So if I were to draw a horizontal line or attempt to, it's going to be something like that. That's like the normal intra-year. Whoops, I didn't mean to double line that. That's like the intra-year decline there. Last year, 2022, we saw 25% intra-year decline. So much larger than normal, and the year ended for the S&P 500 down almost 20%. This year, we've seen 8% intra-year decline. So we've seen less volatility high to low so far. I mean, this is just through March 31st again. So, but if we were looking at data as of today, the intra-year decline is the same. We haven't seen a larger intra-year decline than we saw in March. So a little bit of a historical perspective. Again, the average intra-year decline 14.3%. And we think about averages, we have to be a little careful. Like if you said, I know not everyone on here is from Minnesota, but you say the average temperature in Minnesota is like say 60. Well, I suppose that's accurate, but you're going to have temperatures from like -10 all the way up to 100. So it's not average. It's not 60. The 60 degrees is not the average because it's 60 degrees every single day. It's because it's 80 or it's 20 or it's 10 or it's 40. Once in a while it's 60. So same thing here. It's not average 14% intra-year decline because that's what it goes down every year. You're going to see some big intra-year declines. COVID 2020 down 34%. 2008, 49% high to low, certainly can skew the average. I mentioned a few moments ago when we looked at this slide with the S&P and the Dow, and I said there's a bit of a divergence, even though historically they're move fairly similar. Let's look at that here. That's what this chart is going to be. This is going to be from January 1st of 2022. And why then? Why January 1st of 2022? That was roughly, or it was, well, right around there, the high point all time for the market. And this is through the other day. And since we did this chart, the market's been down a little bit. So we can see that, I'll grab my pen here. Right in here, this would have been about the low point. On that one chart, it said October of 22. Well, that's about when this was, October of 22, the low point. So we've seen a decent recovery off the low point here in the last 18 months or so, but the stock market, as of the time of this chart the other day, not quite back up to its high point. You'll see this big gap in here. Most of the time, the orange and the purple move together. There's this big gap here where the orange way outperformed the purple. The orange is the Dow Jones Industrial Average, and then the purple is going to be the S&P 500. And then right here, the purple way outperformed the orange. And we'll get into why that is later, or what's happening. There's something unique is happening here this year. Now, if I look at the same chart and I bring in bonds are in blue, It's interesting. We saw about the same downturn through October, whether you own stocks or bonds, everything went down about the equal amount in 2022. And another chart here in a few moments that'll illustrate that. We've seen bonds come back some, but since January 1st of 2022, there's the Barclays US aggregate bond index is down like 10%. Certainly hasn't had the recovery like the stock market has, but I think a lot of the downside in bonds could be behind us. Yeah. So more on bonds. Let's go 2 more charts on that. And again, if you have questions, comments, certainly feel free to type those in the chat or the Q&A. And again, I'm going to be looking over at my other screen as I look at the chat and the Q&A. And that's where I would, so if I'm looking over to the other way, that's what I'm looking at there. All right. This is one we shared with you a couple times ago. And what we saw, we had something really unique happen. So what this is going to be the bonds going back to 1976. You'll see that there were only 3 prior to last year, prior to 2022. There were only 3, I think 3 or 4 years. I think it's 4 years where bonds were negative. And the worst of which for the year, calendar year, was down 3% in the mid-90s. Last year, down 13%. And the intra-year decline, high to low in the middle of the year, was 17%. The average intra-year decline, including last year's included in this average, was 3.3%. This is about 5 times the average decline last year. This year, we've gone kind of back to average, as I mentioned in the last slide, that our belief is that the kind of the worst of it for bonds is probably in the rearview mirror. We've seen a 4% decline this year and a return of 3% at the time this was published. This was as of March 31st. We'll have new data here in a few days on June 30th. So again, that's something very unique happened last year. This year, it's kind of become more normal as to how it was. Last one as it relates to bonds and stocks. This is kind of a combination of the 2 other charts. We looked at one that's stocks and one that's bonds for this. And this is going to be a combination. You get 60% bonds, 60% stocks, 40% bonds. This would have been your return for the year. And why you use 60-40? That's a fairly common risk profile for long-term investors. Typically, and there are exceptions here, typically don't have anyone all in bonds or all in stocks. Really a good diversifier is have the 2 of them together. Like last year was kind of the outlier where that type of diversification didn't necessarily work. Grab my pen here. So the returns here, the green is going to be like how the stock market contributed, and the gray is going to be how the bonds contributed. So last year we saw a 16% downturn, and really in, let's call it recent history, there was only one other time where that happened, and that was 2008. But what's interesting about when it was down 20%, but what's interesting is how it ended up down 20 is because the stocks were down, like this green line is down like 23, and that's stocks, and the gray line here, which is bonds, was up 3%. So it's like the teeter-totter effect. Stocks went down, bonds went up, which historically, that's what they were with the crazy movements in interest rates. The teeter-totter effect didn't happen last year. Last year, you're going to see how it ended up down 16% is because a portion of the loss right there was due to stocks, and then the gray, that was right there. That was the bond. But this year again has gotten back to quote unquote normal, or more like a historical average, how the portfolios have historically behaved. So the abnormalities this year, or excuse me, that we saw last year, I think are in the rear view mirror, and we haven't still experienced that any carryover into 2023. So we talk about diversification, stocks and bonds. We still generally like that. I'm going to show the next slide's got a lot of color on it. But if we think about diversification, kind of like going to 2 elevators, if you're going to go up or down, there's some really tall building, and you have 2 elevators. One has, let's say, 1 safety cable, and one has 3 or 4 safety cables. Which elevator are you likely to choose? Well, of course, the one with several or multiple safety cables. So the Same thing applies with investments, still like diversification. And here's a good example of that. I told you it was going to be a lot of color, and that's what you get here. So what this is saying, this goes back, if we look at the very top of your screen, it's going to have years going from 2008 through 2022, and then also year to date. And then it's going to have all different types of asset classes. So if we look at like 2022, and then I'll come into year to date. The year 2022, top performing item was like commodities, dark green, cash, purple, going all the way down to the bottom. Worst performer in 2022 was real estate at like negative 24.9%, 25%. As of the publishing of this chart, the best item in top performer year to date was what they call DM, which would be developed market equity as opposed to emerging market. Think of like Western Europe or Australasia. That's what that would be. It's interesting. This is the first time that I call that dark gray or gray. That's the first time gray has been at the top of the chart. If we go all the way back to 2008. The white is going to be, the white line here is going to be kind of the average of everything. So again, that's the importance of diversification, because you don't always know which, or you don't know which is going to be the best or the worst. What we would say, if we look at going like the average annual, the best has been the large cap, and the large cap is this greenish color, which only two times since 2009 has the green, the large cap, and below the average. It was in 2022 and in 2008. So the good news is, for most of you on here, your largest allocation to your portfolio is going to be large cap stocks. You've been in the thing that, well, since 2008 has performed the best. Let's switch gears a little bit, talk a little bit about inflation. Commonly in the news, if you go to any store, buy anything, you certainly, I would imagine, have felt the effects of it and continue to do so. So let's look at where we are in terms of inflation. So $1 US dollar, 1980, going back to 1980, what would that be worth today? And they publish this data annually. So it's as of the end of 2022. It's 28 cents, which is kind of amazing. But that would be how much $1 has turned into or been cut by inflation. So again, as I mentioned, they only publish, this data is as of March 31st. So the blue line here is going to be your year over year inflation. That's like what they publish if you read the newspaper or turn on the evening news and they say, May inflation was this, or January inflation was this. That's the blue line, is what they're publishing. It's year over year. The orange line is going to be your 3-year average, the orange dotted line. And again, this was as of May. If we were, or as of through March, if you were to, and that was at 6%. If you were to look at May, if we were to fast forward this, it's now like right here. Because May was 4%. That's year over year. But you got to be a little careful with that. We know inflation was really high in 2022. So when you look year over year, you're already starting at a really high spot because inflation was high. So when they do a 1 year, it can sometimes maybe look a little better than it is because you're kind of starting at a high point. And that's why we internally look at the, that average would kind of start to come down a little bit there, at least levelize and start to come down. But if we were to look at where we are, 4%, well, when was the last time we were at that for inflation? It would have been like March of 21. That's the last time we are where we are right now. So the peak, keep this in mind because I'm going to come back to this in a later slide. The peak would have been, I believe, June of 22. That went just over 9%. That was right here. That was June-ish of 2022. That would have been the peak. It was over 9%. As of the last month, 4%. 4% is what they had reported. So targeting 2%. If we look, here's 2%. You can see on the graph. That's what they are. Oops, pen slipped a little bit. That's what they're targeting. And they just came out with some commentary today. So they didn't raise interest rates on the most recent time they could have, but when they do so in July, it sounds like they are going to, or Fed Chairman Powell sounded like they're going to raise rates again. Again, it's going to probably take time to get down to the 2%. You have to be well, actually, the next chart. I'll wait a moment to say what I was going to say, because the next chart says that well. This goes back to 1962. The blue line is going to be like interest rates, like the 10-year Treasury. Yep, versus the orange is going to be year-over-year inflation. Yep, that's going to be, the orange is going to be like this. What was blue on the last chart is now orange, but it just goes back a lot further. There's only been a couple times in history where inflation has been higher than interest rates. In other words, where the orange line has been higher than the blue line. And they're all times in history. So what's happening right now is we've seen this is inflation and again coming down. So we'll likely see a divergence here, but historically, the orange line is less than the inflation is less than the 10-year. So when they raise rates, it's not like instantly inflation goes down. There's definitely a lag time for the interest rate increases to work its way through the economy. That's why maybe one of the reasons why they didn't raise rates here this most recent time, to kind of give the economy a little bit of time to see how all the past interest rate raises have worked themselves through the economy. I'll make a comment here for those of you who maybe have cash or excess cash in the bank account. It's interesting if we just say interest rates have roughly gone up 5% in the last, well, just over a year. So like a year ago, interest rates on like a money market were virtually zero, or maybe point really low. Nowadays, we can see in like a money market, which is liquid, a treasury money market at let's say 4.5%, 5%, somewhere in there on money market, 1-year CDs, certain treasuries, like 1 year and less treasuries, 5% or over 5%. So if you have excess cash, let's say, and you want to talk about other options for cash to get a higher rate, please feel free to reach out, call or email. Be happy to walk through that. Because rates have changed quite drastically. This is going to be certain items as it relates to inflation. People commonly ask about this chart here, so we wanted to include this. At the time, I think overall inflation was at 6% when this was published. And where you probably see inflation the most, be right here, food or the grocery store. One thing where we've seen it go down now or negative is used cars. That car market went through COVID, got really crazy. That's starting to normalize, if you will, or it has normalized a good amount, if you will. But that would be the various kind of goods and services. You can see this is, as I mentioned, 6% is like the overall. Some things are way higher than 6% and some are way less than 6%. I mentioned to keep in mind of when inflation peaked. We shared this slide last time, and I wanted to give you an update of where we are. So inflation peaked in June of 2022. And ignore this number here, because I've updated data. So this is going to be periods of when we had large inflation and peak inflation going back to 1934. And if we just look at this column of stocks, how did stocks do 12 months after peak inflation? The average, 18.1%. It wasn't always positive. Only one time it was negative. That was 2008 when the peak was 2008. So this would be when we look at, well, how did we compare to the average? Like, because we would have had it peaked in June. So we'd look at July 1 of 2022 to June 30th of 2023. So we're almost there. We're like, less than 10 days away. So maybe think to yourself, where do you think we are? And this is the S&P 500. So here's a chart of the S&P 500. let's see, from June 30th of 22 until just the other day, and the average is 18.1, and coincidentally, it's up 18.54% since that time. Now it's down. The last couple of days, it's been down a little bit, but it's kind of interesting that where we are up 18% happens to be the average of these other 8 instances going back to 1934 of where stocks were 12 months after a peak inflation rate. And again, this is the S&P 500 for most of you, depending on your risk level, cash flow needs, your largest exposure, certainly not your whole exposure in your portfolio, but the largest percentage of your portfolio, if you're more of a growth portfolio, probably to this, the S&P 500. A little quiz for you. So this is going to go to speak to the uniqueness of what we've seen in 2023 this year. So if we think about the S&P 500, it's 500 of the largest US companies, but it's what's called market weighted. Well, there's market weighted and there's equal weighted. So if we had equal weighted, that would be 1/500th in each of the 500 stocks. But that's not how the news reports it. So if you look on the internet or on your phone, on the newspaper, and say, well, how did the S&P 500 do yesterday or last month? They're going to quote the market cap weighted, which means the largest companies have the largest weighting. Yep. So it's not 1/500th in every company. You could have, what were you going to see? Like 7 companies are dominating the performance. So with the stock market being up this year, how many companies do you think, or maybe I just said it, maybe I spoiled it. How many companies are contributing to the positive returns of the S&P 500 this year? How many of the largest, let's say? And that's what this is showing. It's like 7. So if we look, and this one is through May 31st. So for those research firms that publish monthly, this is the most recent. Let me grab my pen here. This is if you've heard the term like a narrow market, it's exactly what we're having this year, meaning very select industries or stocks are seeing the vast majority of the appreciation this year. If we look across the top, these are all components of the S&P 500. There's Tesla, Meta, think of that as like Facebook, Amazon, Google, NVIDIA, Microsoft, and Apple. Those 7 stocks. And if I add up, let's say at the time, I'll do a little rounding, the S&P 500 for the year was up like 10%. If I add up the returns of these 7 stocks, it's like 10.25%. And if we look at the other 4, it's on the upper right, the other 493 stocks, if I add those returns together, it's negative 0.25%. So 7 stocks have contributed positive 10.25%. The other 493 have contributed negative 0.25%, having the net return for the year, and again, I'm doing some rounding here, is 10% for the year. So very, very narrow market. You've heard maybe about AI or artificial intelligence. We're seeing, some of that like in Microsoft or NVIDIA, some huge gains in those stocks this year. So maybe you don't own those explicitly in your portfolio, but depending again on your risk level, you should have some S&P 500 exposure. So you do have exposure through those particular holdings, but very, very narrow market. Sometimes you can just say, well, I'm just going to pick any stock and maybe all the stocks go up together. That's not at all what's happening this year. There are many stocks that are flat or barely up or down this year, where you've got other stocks that are way up in the double digits. So very narrow market. All right. So those are the prepared remarks we had as it relates to the market, which of course you and I don't control. I mean, we can control risk and a few other factors that relates to the portfolio, but I want to spend a few moments. I got a couple updated slides as it relates to planning. So the good news we say is you and I do control many, many factors. Of course, we don't control the stock market going up and down, or the bonds, or do they raise interest rates or leave them flat. You and I have no control over that. But we have to always keep in mind that we control, how you save pre-tax versus Roth. from which account to take income and when to start Social Security. And risk is very important. You're giving to charity, from which accounts to give charity and when. Spendable income, not necessarily the same as taxable income. Again, that goes back to from which account you take income and when. Very, very important. You have big tax ramifications now and in the future. Of course, you control how much you spend. You know, when you make large purchases, or you use cash or debt, that conversation changed quite a bit with interest rates, and the list goes on. We've got this visual I want to share with you. So generally, people have at least 3 buckets of money, and you may have 5, maybe even more. So from which account to take income and when you turn on the income from these various buckets has a big impact on taxes. And we've used some color coding across the bottom. Let's say if you have a pension or land rent, let's say farm rent, we see that a decent amount, 100% taxable, ordinary income rates. Come back to this one. IRA distributions, unless you're giving money to charity, and you have to do it the proper way through QCD, qualified charitable distributions. It's going to be 100% taxable unless you're doing QCDs. Roth, 0% taxable if you're taking qualified Roth distributions. That's why that is green. So that's tax-free, 0% taxable, tax-free. Non-IRA accounts, that's going to depend, 0 to 90% taxable, depending on gains. You only pay tax on the interest or the gains, and you only pay tax on gains when you sell something. So you have control there. You have an asterisk there that's potentially taxed at very favorable long-term capital gains rates. And then we come back to Social Security of this big range, 0 to 85% taxable. That's largely dependent on how much you take out of this bucket, and possibly this bucket. The more you take out of the taxable buckets, the greater percentage of Social Security is subject to tax. So again, from which account you take income and when, that's where we can be very helpful. That is something you and I absolutely 100% control. So taxes, we spoke a little bit about taxes. I've got 2 slides here on taxes. It's very important here. Again, from which account you take income and when, how you give to charity, that's going to determine your tax bracket. And this is for a married couple. The numbers are different, but the concept is the same for single folks. So this is going to be the 2023 tax rates right here. So we think like the first 22,000 of income, you pay 10%. The next 70,000, 75,000, you pay 12%. Any income over 89,450, you start paying 22%. So if you go $1 over, it's not a big deal. If you go $1 over on other things, like what's called an IRMA surcharge, I'm not going to get into that now. That becomes a big deal. But if you go $1 over, it's not a big deal because only the income over the 89,450 goes to the 22% bracket. But what we see here is that if Congress doesn't act in 2026 and beyond, tax rates are going to go up, where the 22% bracket becomes either 25 or 28. The 24 becomes 28 or 23 or 33, excuse me, it's 27% increase. So why tax planning is so important for some folks, certainly not all. It may make sense to have more taxable income now. You pay tax sooner than you would have to. It's counterintuitive to think, well, I don't want to pay taxes before I have to. But if I can pay taxes now at a much lower rate than they're probably going to be in the future, it may make sense. Definitely an individual conversation. So we'll continue to have those in your meetings. So the planning software we use, we've got an update to it. I'm going to share that chart next. A lot of you have probably not seen this. So the retirement success analysis as part of the Dream Architect planning process. This is a chart here where we're showing we've built in the tax rates to a bar chart, and we haven't built in yet we've built in the increases down here at the bottom when it goes from 12 to 15 and the 22 goes to 25 or higher. But the blue bars would be like your income, let's say your taxable income, and this orange line is going to be the top of the 22 or 25, and the green line is going to be top of the 12 or 15. And how this helps with planning is as we forecast future income. Again, we know pretty much what your Social Security is going to be if you're not on Social Security, and we we know what your distributions, like your taxable income, is going to be in the future, unless your spending changes drastically. So if we just look at this, an opportunity jumps out right here. This is saying 2023 through about 27 or 28, and especially here, right there. What we see is there is room in the 12 or 15% bracket, and we know in the future we'd have income, all this income is in the 22 or 25 bracket. So we'd want to say, well, let's fill this up here. We need to fill this up under the green line. Let's take advantage of that. Let's put some money in the 12% bracket these next few years. I'd rather pay 12% than 22 or 25. So that's an extra visual that, depending on your situation, we may go through as part of the Dream Architect process. I'm not going to go through the next 4 items. Fast forward again, the Dream Architect planning process. That's what I was showing there. The retirement success analysis is part of that. So we're a few minutes early. We're five or so minutes early. I've included in concluding. I've included my email address there, Oliver@sweetfinancial.com. That does come directly to me. I do check it daily. So if you have questions, certainly feel free to email me. I absolutely will reply, or feel free to call. So again, we always want to be a resource to you or loved ones or family or friends, those you care about. So any questions or can be helpful in any way, always feel free to reach out. I don't see any other questions. I'm looking at the screen, some kind words, and so I appreciate those of you, who kind of said thank you or good information. I got one. We have a new certification, a certified exit planner. So it's a CEPA designation. I passed an exam here, and one person congratulations, pass along some congratulations on that. So thank you to you who submitted that. So with that, if no questions, we'll wish you a wonderful day. And again, always feel free to reach out. Happy to be a resource in any way. Have a great day, everyone. Bye-bye.